So Mark Andreessen's on our board. And when I got the Samsara offer, he called me up and said, hey, congratulations. Meet me for a glass of champagne. I carry this notebook with me everywhere. It's like what I use to take all my notes. And I had printed out the financial model. So I show up to this meeting, I bring in my notebook. He gives me an hour of his time and he's answering all my questions. I got in my car and I'm driving home. And I look on my passenger seat and I see the model is not in my notebook. And I panic because I just got the CFO job. I immediately called the restaurant. Mark's not there, and this document is not there either. I immediately call him and I say, hey, I left something at the restaurant. I didn't say what it was. He's like, oh, yes, I do. I have it. I'll mail it to you. I said, I'd really like it back now. And he gave me his address. So I drive over to get it, and he comes out and he hands it to me like in a manila envelope, basically. He doesn't say anything. And I said, thank you. And I drove away. Man, what a biff that would have been had somehow someone else gotten a hold of this model as I'm the first CFO of the company.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to Run the Numbers. Today on the show, I'm joined by Dominic Phillips, the CFO of Samsara, a company that went from startup to public darling in under a decade, and now does over $1 billion in annual revenue. Dominic's been with Samsara for more than 6 years, guiding the company through hypergrowth, pandemic-era uncertainty, gnarly supply chain chaos, and yes, an IPO at the tail end of 2021, right before the tech window slammed shut. So if you're looking for a CFO who's had to balance planning, storytelling, and investor education in real time, this is the guy you want to learn from. Before Samsara, Dominic spent years climbing the finance ranks at ServiceNow, working under the legendary Mike Scarpelli of Snowflake with stints in FP&A, corp dev, treasury, IR, you name it. We talk about how those roles shaped his view of capital allocation, Wall Street communications, and what it really takes to build a durable finance function in a modern SaaS business. We also get into Samsara's unique customer base, companies with heavy physical operations like trucking, logistics, and construction, and why selling into non-discretionary budgets has shaped their pricing, packaging, and go-to-market playbook. This episode is packed with lessons on going public, scaling with purpose, and what to do when you're handed a 30-analyst coverage universe in a market that still doesn't 100% know what Internet of Things actually means. All this and much, much more after a short word from our sponsors. Well. Here's what nobody tells you about being a CFO. You'll spend 50% of your time on stuff that is killing your momentum. The best CFOs I know are business leaders who know how to drive growth in heroic fashion. But most of us end up spending our days buried in manual work. I'm talking about collecting receipts, reviewing expenses, and manually reconciling spend. It's painful. That's why CFOs need Brex. Brex built an intelligent finance platform that pairs corporate cards with built-in expense management, plus a team of AI agents to handle the manual finance tasks for you. That way CFOs have more time for the high-impact projects that drive growth. You know, the shit actually worthy of your CFO time. Bottom line, Brex is automating hundreds of thousands of hours of manual finance work every month across 35,000 companies like Anthropic, Coinbase, and DoorDash. Ready to spend less time buried in expenses and more time driving results? Check out Brex at brex.com/metrics. It is brex.com/metrics. Please, guys. How the hell do I have 3 kids in daycare? Brex.com/metrics. You just launched your new AI product. The new pricing page looks great. I'm talking crisp. But behind it, last-minute glued code, messy spreadsheets, and running ad hoc queries to figure out what to bill. Customers get invoices they can't understand. Engineers are chasing billing bugs. Finance can't close the books. Well, with Metronome, you hand it all off to the real-time billing infrastructure that just works. Reliable, flexible, and built to grow with you. They turn raw usage events into accurate invoices, give customers bills they actually understand, and keep every team in sync in real time. Whether you're launching usage-based pricing, managing enterprise contracts, or rolling out new AI services, Metronome does the heavy lifting so you can focus on your product, not your billing. That's why some of the fastest growing companies in the world like OpenAI and Anthropic run their billing on Metronome. Visit metronome.com to learn more. That's metronome.com. Here's a growth tax nobody talks about. Every new monetization model you ship creates a nightmare for your finance team. Add usage-based pricing? Now you're tracking consumption against commitments. Launch product bundles? That's multiple performance obligations per contract. Offer mid-cycle upgrades? Woo! Good luck reallocating revenue manually. The irony is brutal. The pricing innovations that drive growth are the same ones that often break your finance process. But that's exactly where RightRev shines. RightRev is the revenue recognition engine built for companies that can't afford to let accounting slow down growth. Here's what most people miss, and I've come to deeply appreciate. Revenue recognition isn't just a finance problem, it's a go-to-market enabler. When your rev rec is automated, your product team can ship new pricing without asking finance for permission. And your sales team can close creative deals without worrying about downstream chaos. To get up on my CFO soapbox for a sec, I love talking about creative pricing models, hybrid pricing, credits, tiered usage. It's where real growth happens. But I've seen too many companies where the sales team is celebrating a huge quarter while finance is still trying to figure out how to recognize half of it and crying in the corner. RightRev lets you experiment with pricing without wrecking your close process. And honestly, in a world where your pricing model might change 3 times next year, that flexibility is everything. If you want to scale your monetization without breaking your books, visit RightRev.com. That's RightRev.com, where modern monetization meets bulletproof accounting. Dominic, thanks for spending time with me today.
Thanks for having me on.
I have to say, you are one of my great white whales CFOs, so thank you for helping me check a box on this Friday.
You're very persistent, and it pays off, and I'm glad we could find time to get together.
Thank you, sir. Well, before we get into your CFO playbook and experiences, I just want to get the overview of how you ended up at Samsara, because you've had quite the illustrious career, which has spanned a couple different industries. What prepared you for this role?
Coming out of school, I was actually an accountant, a CPA. I started in public accounting at PwC, and it was this is a pretty good opportunity coming out of school to work on a bunch of different projects throughout the year. Pretty early on, you get to manage and review the work of earlier kind of associates. You get to engage directly with clients. It's super collegial. So it was a great way to start my career. I knew that I wasn't going to be a lifelong accountant. And so even in undergrad, I actually took my GMAT, knowing that the scores are good for 5 years. And I'd probably eventually need to use business school as a way to transition into something else. And I did that. So I stayed at PwC for about 4 years, went back to business school with a sole purpose of transitioning into investment banking. I graduated in 2010, so it was I nailed the timing in terms of the great financial crisis. Awesome that I was in school and avoided all of the craziness. It was really hard to get an internship. This was summer of 2009 to get an investment banking internship. I ended up landing at Citi for the summer, and there was one IPO all summer long, and it happened to be Avago, and I got staffed on it, which is pretty cool. Now seeing how awesome of a company, Avago, obviously now part of Broadcom. It's this behemoth company. After graduating, I landed full-time at Morgan Stanley in their kind of tech investment banking team in Menlo Park. I was on the software and internet coverage team, and so I did a bunch of IPOs and M&A transactions. I was on the Pandora IPO, just wrapped it up. The staffer came into my office and said, I need you on another IPO. And you can either do this small little consumer security company, it's in Europe, or you can work on this little small IT help desk company down in San Diego. And, I had a kid that was 6 months old. And I'm well, San Diego's a lot closer than Europe. And so I'll do the help desk company. It turned out that was ServiceNow. So I was on the ServiceNow coverage team, and I helped them do an IPO. They ended up doing a follow-on offering. They did a convertible debt offering over the course of 18 months. And I got to know Frank and Mike and Fred, the founder, incredibly well through all those transactions. Got kind of promoted to VP at Morgan Stanley and decided to jump over to ServiceNow. And it was 300 million of revenue, 1,000 employees. And I got a chance to run IR, corp dev, eventually picked up FP&A and treasury. And then when Mike left ServiceNow to join Frank again at Snowflake, that was when I exited late 2019 to join Samsara as the company's first CFO, my first CFO job. The company was 100 million of revenue and over 1,000 employees.
Wow. And you've been CFO of Samsara for over 6 years now. And that period's included a pandemic, a major supply chain challenge, and you also took the company public. And you've been scaling the business tenfold. Can you kind of walk us through that journey and some of the pivotal moments or decisions that helped you?
Yeah, it's been a crazy journey over the last 6 years. So I joined Samsara December of 2019. The company was was ripping. I mean, just like crazy hyperscale, was burning more money than I probably appreciated when I took the job, but just taking a lot of shots on goal in terms of, they were investing across a bunch of new products. They were in a bunch of geographies, kind of doing a lot of experiments, and things were going great. There was like unlimited access to capital, because you're growing so quickly. 4 months in, things got serious really quickly, and COVID hit. Obviously, we went into like a global economic shutdown for the first 2 quarters of 2020, and we really started to lose visibility in our bookings. And this was like a company that had basically raised capital every year, like once a year, and it was always preempted by the insiders, Mark Andreessen at A16Z, and then Hemant today at General Catalyst. So the plan was like, we'll just raise capital in the summer. When COVID hit, we're like, we really need to pull in fundraising and do this now, and we need to find a way to right size our burn. Fundraising is never easy, but it was really, really difficult in April of 2020. I looked at a bunch of different options. I was looking at hairy debt deals with warrants and high PIK interest rates, and I was looking at revolving credit facilities. Eventually, we landed a clean equity round, but it was a down round. We used that as an opportunity to raise enough capital to never need to raise money again. We didn't know if this was going to be, a couple month economic downturn, or if this was going to last a bunch of different years. In conjunction with that, we did a 20% layoff, a RIF to basically right size the business. We eliminated some of these newer bets that we were working on. We got the business stable, but this was like in my first 6 months as a CFO. And then obviously in the second half of 2020, rates went super low, economy started ripping again, and our growth really took off and resumed. We went into 2021. I don't know, like 150 software companies went public that year. We were like ready to go. We ended up filing our S1 confidentially in March of 21. We have supply chain exposure. We provide these IoT devices to collect data off of these physical assets. So the supply chain crunch in 2021 really, really hit us, where supply chain completely shut down when COVID happened, and then it couldn't turn on fast enough to meet all of this demand that came back online. And so it really limited our visibility into our bookings, and we ended up delaying our IPO until the end of 21. But we were able to get out. Finally, we're the last ones out in 2021. And then obviously we've now been public for about 4 years, and we've been able to sustain high growth, and we've gotten a lot more efficient over the last 4 years.
What a whipsaw coming in, right?
Yeah, it was a wild time.
Well, taking a company public, it always requires careful messaging, even more so, I think, in your situation. I think you had to do a lot of investor education just around your business model and the industry. What were the biggest communication challenges, and how did you think about building the right long-term investor and analyst base?
Samsara is tricky. It was like a non-standard IPO, meaning it didn't fit cleanly into like a recognizable bucket.
No.
Investors really like to do pattern matching, and there weren't a lot of other kind of public comps like Samsara. We didn't have a lot of investor brand when I joined because, again, the two VCs effectively, preempted and led every round. And so, the obvious questions were like, is this a software company or is this a hardware company? Is this a vertical SaaS company or is this horizontal SaaS? Does it have the unit economics to ever break even? Can it ever be profitable? And coming out of finance, as you probably appreciate, like the answers to these questions result in a very different outcome of how investors are going to value your company. So I took those first 2 years, and there was a lot of investor education before we went public. And so making it really clear that this is a SaaS business model. Instead of seat-based pricing, it's asset-based pricing. But 98% of our revenue is recurring. Our core metric is ARR, just like it is for Salesforce and ServiceNow and Workday and all of these other business models you're familiar with. We are diversified across many different industries. We don't just sell into trucking, but we sell into 12 different end markets, and none of those end markets represent more than 20% of our revenue. So more horizontal than vertical. And then showing them the unit economics on the business, the lifetime value to CAC ratio or net retention rates, to prove to them that the strength of the unit economics would eventually result in long-term, free cash flow leverage. I was also really focused on the sell-side analysts that were going to cover the company coming out of the IPO. It was critical that we got the software SaaS research analysts, not the folks that cover kind of the hardware low margin names. And so I was able to use a lot of the relationships that I built at ServiceNow, both on the buy side and the sell side, to get the right people kind of focused on it as we were getting ready to go public.
And I'm a dork, so I actually remember printing out your S1 back in the day because I was running investor relations at a private security company at the time, and we're trying to learn about the market comps, how to communicate a story. And I remember highlighting asset-based pricing, and I was like, "All right, this is different, and this is cool."
It's different, and in this environment, it's been great because unemployment rates may go up, and that if you're selling software that's tied to seats and that may be disrupted by AI, we've been able to lean on the fact that we're selling into asset-intensive industries, and they need all of these assets to generate revenue. And because we price on a per asset basis, you get the benefits of the predictability and visibility into SaaS revenue, but without the kind of the downside exposure of being tied to seat-based licenses.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Being a CFO, you know how much I love tools that actually make the lives of accounting and finance folks easier. One of my favorite tools right now is Rillet, the AI native ERP going head to head with NetSuite. Yes, someone is finally doing it. I met Rillet 2 years ago when they were still in stealth. Since then, they've absolutely taken the finance world by storm. Their mission is to make the zero-day close a reality, and they're actually doing it. Customers are literally closing their books at 1:35 p.m. on the first day of the month. They've got everything you need to scale your business. Complex revenue recognition, native integrations, custom reporting, multi-entity, close management, and much more. They're only a few years in and are already supporting NASDAQ publicly listed companies. Yes, seriously. If you want to scale your business on an ERP that wasn't built in the 90s, you need to check out Rillet. Book a demo at rillet.com/CJ. Oh, cool, that's me. That's RILLET.com/CJ. RILLET.com/CJ. Tell them I sent you there. This next segment is brought to you by Tabs, a company I've been following closely for quite a while. And if you're a CFO or controller listening, this is one you should pay attention to, because this is where billing and revenue automation is headed, especially in a world of usage-based pricing. Ali and the team at Tabs are building something that directly addresses one of the biggest headaches I see finance teams deal with today: pulling data from your ERP, your CRM, your FP&A tools, and your usage systems and actually making it all work together. If you're running usage-based pricing or complex contracts, you already know how this usually plays out. Contracts live in one system, usage data lives somewhere else, billing happens in another tool. RevRec gets layered on top at month end, and finance ends up just reconciling everything by hand to close the books. It works for a while until close slows down, RevRec gets fragile, and wait for it, cash shows up later than it should. This is exactly the problem Tabs was built to solve. Tabs is an AI-native revenue platform built for controllers and CFOs. It brings together data from your ERP, CRM, and real product usage into a single system of record. From there, it automates billing, collections, and revenue recognition without finance having to duct tape workflows together every month. No CSV uploads, no manual reconciliations, no end-of-month fire drills. Companies like Cortex, StatSig, and Cursor are already using Tabs to scale revenue per employee, save hours every close, recognize revenue cleanly, and get paid faster. If usage-based revenue is core to your business, this is the future of how billing and RevRec get done. Go check them out at tabs.com/run. That's tabs.com/run. Now, if you listen to Run the Numbers, you know that I have a love-hate relationship with finance tech. We've all been burned. We've all bought that enterprise planning tool that promised the world, only to realize 6 months later that we've basically taken on a second full-time job just to keep the software running. I want to talk about a company that was built specifically to kill that cycle: Abacum. I actually remember my very first conversation with their founder and CEO, Julio Martinez, over 3 years ago. Back then, they were just starting out in Spain. What struck me most was his frustration with these massive legacy planning platforms that had long implementations, expensive consultants, and after all that work, you're still struggling to get answers and manage the system. He and his co-founder Jorge are both former CFOs. I knew I liked those guys. Fast forward to today, Julio moved the home base to NYC. They've raised over $100 million in capital from heavy hitters like Scale Venture Partners, and they're the engine behind finance teams at Strava, Replit, and JG Wentworth. When a company like Strava, where the data volume is massive, trusts you with their planning, you know the tech is robust. But here's why I really like them. Abacum doesn't turn you into a software admin. The integrations are actually self-service. You don't need a $300 an hour consultant to plug in your ERP or HRIS, and they're doing AI in a way that actually impacts the things FP&A teams are doing every day. Things like creating variance summaries, building formulas, and modeling scenarios. If you're scaling fast and you're trying to avoid that legacy platform trap, Abacum is the move. They're building the future of our tech stack, and they're doing it with a CFO's perspective. Go to abacum.ai to see it for yourself. That is abacum.ai. And I just want to call it out and give Samsara their flowers. Like you kind of led the way for all these companies that combine a software and hardware element to be seen as sexy as they are today. Like the story wasn't right down the fairway, but you look at all these companies that are innovating now, especially in the private space and may go public over the next couple of years, like they have comps now for how to tell that story.
Hardware is much more in vogue today than it was 6 years ago. 6 years ago, it was about software data, SaaS consumption. It took a lot of investor education to get the right folks around the table, to get the company positioned correctly, such that Samsara's had a roughly top 10 revenue multiple now for the last kind of 3 years, like tied in with all of these other, what would be considered like pure play software companies.
That's exactly what I want to get to, because now that we have a good sense of your background and some of the experiences that you navigated, I feel like a ton of us know the Samsara name because it shows up in those top 10 comps, top 10 EV to revenue multiples, but we're not like entirely sure what you actually do. By the way, you have the coolest ticker ever, IoT. Can you give us just the elevator pitch of what you sell, who your customers are, and the core value that you drive?
Yep. Yeah, absolutely. So Samsara, we're the system of record for the world of physical operations. So if you think about industries like construction and energy, oil and gas, transportation, public sector, field services, et cetera, all of those industries make up about 40% of global GDP. They're really large, and they traditionally have been very underserved by technology, and they still use a lot of manual processes. And so we have a full stack IoT solution. We instrument the physical assets, whether that's a vehicle, field equipment, tools, small assets, and then we pull a bunch of data off of these assets. We collect more than 20 trillion data points every year. We pull them into the Samsara cloud, and then we're using AI to surface actionable insights on top of that data that allow our customers to take action. So we help them save money on fuel. We help them lower their maintenance and labor costs. We help them improve their safety and reduce their accident costs, lower their insurance premiums, meet their sustainability goals. So those are the kind of the applications and the ROI we're delivering. We're selling primarily to large enterprise customers that have complex physical operations. So about 60% of our ARR comes from customers that pay more than 100K of ARR. And then more than 20% of our ARR comes from $1 million plus ARR customers. And that's accelerating. We're at 1.6 billion of ARR, still growing 30% a year. 6 years after I've joined, we're now generating free cash flow margins in the teens.
So if I had to, I'd put you in the vertical software bucket, but I have to say 40% of global GDP, that's a pretty wide swath.
We're selling into more than a dozen, verticals. So similar to those other kind of horizontal platforms that you're probably really familiar with, we're really focused on products and features that cater, to all of those industries. Again, as I said, our end markets are really asset and people intensive, whether they're in waste management or they're a utilities company. And we help them manage their assets and their workers all on the same kind of set of applications. And then for like the vertical specific software that's required in those industries, we integrate with more than 350 vendors. We have an app marketplace. So maybe not the typical depth that you would see in a true siloed vertical software company, but we have the benefit of selling into several of these really large markets, which gives us a lot of opportunity.
Dominic, you're relatively young as a company, though, but by my count, around 10 years or so, and you're already doing well over $1 billion in revenue. What do you think the key insight is, or how the company has continued to approach the market that allowed for this durable growth in such a short time?
We have, again, these very large and super underpenetrated markets. And so we see that opportunity, and we definitely prioritize driving durable and sustained growth, really to have, as much impact as we possibly can for our customers. And so I would say the growth drivers of the business are multifaceted. From a a product perspective, we're expanding well beyond vehicles to tracking assets out in the field. We've even created like an Apple AirTag like product that uses our own network. We've built a number of ancillary software only products. So asset maintenance, routing, commercial navigation, workflows. So I think the extensibility of the product portfolio is a big driver of growth for us. The second one would be customer segments. It's a business that really started selling originally into mid-market, but has shifted much more of the business now to large enterprises. Again, large enterprise customers have incredible unit economics. They're very sticky. They buy a lot of products. They can be very large. They're great sources of feedback to drive the product roadmap. International would be a third really important growth driver for us. So about 15% of our ARR now comes outside of the US, so Canada, Mexico. There are more physical operations assets in Europe, for example, than there are in the US. So massive international opportunities still in front of us. And then the last one I would say is verticals. While we don't focus on one specific vertical, there are several of them where we've been able to go deeper and drive more meaningful growth. So construction has been our leading vertical for 8 quarters in a row. We're starting to get into airlines. Public sector investments are really starting to pay off as well.
As somebody who terminally online and just looking at tech stuff, it's so refreshing to talk about stuff in the real world. Like, yeah, it's tech, but like it's fun to talk about heavy physical operations, construction, transportation, warehousing. It's a nice change of pace. What are the advantages of this software approach in your business? And are there any hidden challenges actually that you have to navigate?
It's a big advantage with investors because it's simple to understand. Like if I worked at like a data infrastructure company, it would be more challenging to explain like what we do. It'd be much more abstract. And so it's very simple to demonstrate to investors, this is exactly how customers are using the product. Everyone is familiar with these industries. They understand what these assets do and what they're used for, and they understand that these are real costs. And so being able to demonstrate really easily, here's how they use the application, here's how we surface the data, here's how we use AI to automate a lot of this work for them, and then here's exactly how they're driving ROI. Every software company generates like productivity, like that's kind of the ROI. Like we talk about like our finance sector, like we use NetSuite. We definitely need NetSuite. It's hard for me to quantify what is the actual ROI as a result of using the software. For Samsara, we can show you that this is what your business looked like before. Like here's how much you spent on fuel or on maintenance. This is what your kind of accident related costs or your insurance premiums were before. And then after you deploy the technology, here's how your cost stack looks after. And so very demonstrable and very tangible ROI makes it much easier to have conversations with customers, but also with investors.
And also, Dominic, just hearing you explain what you do, it's like, oh, I get it. I worked at a company where we sold backup and recovery software. Like if my aunt asked me at a Christmas party to explain what our product did, like I was a sailor lost at sea.
It's very clear. It's very easy to understand, and investors definitely get it.
Many of the customers have been around for 50, 100 years, and they're probably running legacy operations. How does that depth of history impact how you sell, structure your offering, and manage change?
The majority of our customers have been around for decades, and when we go in, it's incredible because in our consumer lives, everything is on a mobile app. Even like in the enterprise, at work, like everything is digitized now. You go into some of these physical operations businesses that have been around for 50 or 100 years, and it's like walking back in time. There's so many manual processes, and so they're really looking to us to help them digitally transform their businesses. It's often like a journey that will start out with one project, but then we'll gradually expand that across different use cases over time. For these customers, a big consideration is change management because they can't afford to like interrupt their operations. This is what they're doing to generate revenue, and so they can't have anything go down or be offline. And so they're looking to us for best practices. They want to know, what are the change management playbooks? Can you provide me benchmarking data so we know like what does good look like as we progress and transform our operations? And so it's more consultative. It's more of this kind of advisory relationship, and it happens over time, which obviously builds a lot of loyalty.
So I listen to a lot of earnings calls, and sometimes I'll write down a term when I think it's like, oh wow, I gotta figure out how to use that, like when I pitch something. or I need to write about this. And I've heard you drop the term that you're selling into non-discretionary budgets, and like my spidey senses went up. Like I got to figure out this. Well, what does that mean? Is it like the cost of downtime, the cost of inefficiency? Like, what does that term mean?
This is my storytelling attempt at really trying to create a little separation from Samsara, from some of the traditional SaaS companies that, again, are either tied to seat-based pricing or are tied to IT budgets where maybe those budgets are a little bit more discretionary. So we talk about selling into the operations budget. And for these physical operations customers, on average, they spend 80% of their revenue on their operations budget. All of their frontline workers, all of their assets, all of their vehicles, all of the money they spend on fuel and maintenance, and all of their accidents and insurance, all of that, those go into the operations budget. And that's what we're attacking. As I said, this is really a big ROI sale. And so if we can go into this really large budget and we can help you shave down your operating expenses by deploying our technology, even by a few percentage points, there's massive amounts of savings to be had because the budgets are so large and they're non-discretionary because they have to spend them to generate revenue. And so we often will do a free trial before we actually sell it. And then after it's deployed, we've done some research that customers are generating and on average an 8x ROI versus what they're spending on their Samsara investment.
And I bring it up because like this is the inside baseball that people come to the podcast for. What terms can I steal and put in my toolkit? And I think it's a really cool way to pitch it because it makes it obvious that like it's coming from a place where it's going to be stickier. If you prove the value, they're gonna keep spending with you.
That's right. If it's very large and they absolutely are going to spend this money on things that are going to drive revenue, and you're going to help them directly save money on that budget and it's quantifiable, all of those kind of phrases and words that I'm using in the kind of the earnings call are intended to make that very apparent to investors so that they keep us in the same high growth software bucket, but maybe not in terms of the potential risks that some of these other businesses are facing.
I like how you alluded to there's less risk in that. And you do a really good job, Dominic, in your storytelling of describing who your end customer is. Even though, like you said, you serve multiple verticals, it's helpful to know who's the person making the decision and holding the budget at the end of the day. And that was like a really big learning for me as a CFO when I started to think about who's the budget holder and what do they find important.
And these are the folks that not only are they're hiring all the people and they're buying all the assets, they're calling on the customers, they're winning the business. One of the things that we often have to think through as we're selling to them is anytime they're spending with us, they are not spending on their business and driving it forward. And so we're really asking them to take time out of their really busy day of operating their business to consider a large digital transformation kind of change. And so finding time and not wasting their time is an opportunity, but a challenge, as opposed to my CIO and my CISO probably get 100 vendor calls a day. I mean, that's like a huge part of their job is to understand what all of the technology is that is out there. They don't have as much time to carve out to spend to think about technology changes.
I love your storytelling. You come from the Mike Scarpelli coaching tree. So I'm going through slowly here. So we've had John McCauley on, we've had Andrew Casey on, we've now had you on. It's an illustrious coaching tree of public company CFOs. Can you just tell the story of getting to know Mike? I think you were at Morgan Stanley at the time.
There's a Greg Henry at One
Oh
Password.
yeah, Greg's a huge friend of the podcast. He's been on twice.
There's a Amir Jafari. Lisa Banks is at Abnormal. Jimmy Sexton just landed at ClickHouse. So it's pretty incredible. I mean, he has like over half a dozen folks that used to work on his teams that are now CFOs. And like Mike is incredible. He is such a fantastic mentor. And yeah, I started building a relationship with him when I was a banker at Morgan Stanley, and you know, we were leading the ServiceNow IPO. And so you go through an IPO process, you spend a lot of time with the management team, and we did it over several transactions. So the IPO, the follow-on offering, the convertible debt offering, and through that time, you know, over those couple of years, we got really close, and that was a huge reason I decided to jump over and join him and Frank and Fred over at ServiceNow. But yeah, there are a lot of I would say like Scarpelliisms that stand out to me. If I had to pick a few of them, email is a super like a poor form of communication. Stuff gets lost in email. People can be more passive aggressive. If you've got a challenging topic, you pick up the phone, you call someone, you go see them in person, face to face. You do not send them an email. Email is a poor form of communication per Scarpelli. Second, he was really, really big on having strong cross-functional relationships. Like his relationship with David Schneider, eventually became president, but the CRO was fantastic. Just a ton of mutual respect for each other, able to have good debates and kind of go back and forth with each other. Mike was always really big on it's important that everyone around the table that you can work well with them, that they like you, that they respect you, but that you can have good debates about kind of hairy topics. The last one is hire the best people you can. For all of the functions around you, hire the best person that you possibly can. People that would be way better at those functions than you ever would be. You should get the best folks around the table, and that's going to be the best thing for the company and ultimately for your ability to focus your time on the big, important strategic things that the company needs from you.
The pick up the phone one, that hit me like a ton of bricks. I feel like I gotta get better at that. And I feel like it's a great lesson for finance people who can often hide behind, like, I have the numbers and write about it, like, here are the facts.
COVID hits and people start working from home, email usage, really, really shot up. And so I think more and more people are getting back into the office, and that's the advantage. You see someone in person, you can have a very direct conversation. You can read body language. There's a lot less room for misunderstanding something. And so pick up the phone, see someone, face to face. Those are things Mike's really big on.
Your prior role included responsibility, I think I have this right, for over 30 sell-side analysts. ServiceNow is a hot company. It still is one of the best out there. You have to manage their expectations day to day. For aspiring CFOs who might be in smaller companies right now, what are your top rules for managing analysts?
I'm a big sports fan. So like companies like the sports team, the analysts are like the media, and then the investors are like the fans. And so like the analysts are the like the conduit for what your messages are to the fans or to the investors. And so use the analyst to appropriately set expectations, have them help you amplify your key messages. Investors hate surprises. And so the more you can communicate consistently with analysts, the more likely it is that investors are going to get the right messages. Understand their strengths and weaknesses. There's some research analysts that are super technical. Some of them are maybe a little bit more high level and more relationship focused. But based on the question you have or what you're trying to accomplish, different analysts can help you in different ways. I think something that's underappreciated is use them as a resource. Ask them questions about what are they hearing? Where can Samsara tighten up our messaging? What are we saying that's working with investors versus what's not working with investors? Who are new investors that I should meet with that I've not spent any time with? What are other companies mentioning or disclosing that we should consider, going into our earnings call? So you're giving them a lot of information. Make sure that you're getting information out of the relationship as well.
Patrick Carlson has a podcast called Cheeky Pint, and he had Susan Lee, the CFO of Meta, on, and she was telling a story where Mark Zuckerberg and her were trying to tell the metaverse story, and eventually, like, the analyst, I think they asked, "Hey, are there any questions in the call?" And it was just silence at the end, and they said, "Hey, we don't have any questions, but we just wanted to give you some feedback." And so it was on, like, their projections and where the roadmap was going with basically living life online. And she said it really opened my eyes to it being like a two-way dialogue with the analysts. It wasn't just like us telling the story. It was, oh, we can actually get something from them to tighten up how we pitch it.
These analysts are on so many earnings calls. Many of them have been doing it for decades. They've seen so many different patterns. They've seen so many different companies and business models. They talk to all of the investors. It's like an incredible like treasure trove of knowledge. And they're very open to providing feedback and giving you that information. And obviously that's what builds the kind of the good two-way relationship. So I think that's something that's a strategy that's probably underutilized.
You make a great point because they're not just covering your company, right? Like each analyst covers at least 10 others, I would guess.
Even more probably.
Yeah, so they get mental reps at like what does a durable P&L look like?
What are other companies talking about? How is that kind of resonating? There's strategy, and like when you have your earnings call vis-a-vis other companies, ServiceNow, another Scarpelli thing. He closes fast and he wants to report fast. He wants to get all of that out of the way as soon as possible. And so ServiceNow is still, I think, for the calendar year-end companies, they're generally one of the first ones that report. The downside is you don't get to see what other people are talking about and potentially factor that into your messaging.
Oh, that is so cool. Can you just say more about that? Like reporting really quickly versus waiting to see what happens or what others are saying. I've never dug into that before.
The quarter's 13 weeks. And so like the longer you take to report, the less time you have to spend with investors. The earlier you report, the more time you have to spend with investors. And so Netflix is like always the first to report their earnings for tech companies, which is awesome. They get to spend a lot of time with investors, but they don't get the benefit of hearing what are potentially their peers or their competitors. What are they talking about? I listen to a lot of other earnings calls. I read a lot of other research reports of other high growth tech companies before my earnings call. I want to know what are the questions that people are being asked, what's topical, so that I'm prepared, because it's very likely that I'm going to get asked those same exact questions.
Yeah, there's always like a soup du jour each quarter. Like, what are people going to ask? Because they've asked the other 5 companies that came before me the exact same question.
I want to be as prepared as possible going into those earnings calls and not have any surprises. I'd say we're right in the middle. We're not one of the last to report. We're not the first, but enough to see a few companies before us, report that we can kind of factor that in.
And if you wait till the last moment, what are the negatives of that?
I mean, there's also just a little bit of like, what's taking you so long? Like, why can't you close your books a little bit faster? Like, why can't you reforecast faster? What is taking you so long? It signals that you're probably not closing and reforecasting, and your processes are as tight as they should be. So again, like best in class is like week 4 after earnings. And I think the bigger you get and the more kind of streamlined these processes are, you try to kind of move it forward as well.
I feel like you're a student of the game and you look at the other metrics that companies like you disclose and guide to. What's your philosophy around that?
Obviously, I spent a bunch of time thinking about this, even back running IR at ServiceNow. ServiceNow used to report and guide billings. I don't think they do it anymore. But like, if you were a SaaS company in the like mid 2010s, billings was like what ARR is today. So, and the reality is like billings is slightly better than revenue in terms of what happened in the quarter for these subscription models. The revenue in the quarter really has nothing to do with what happened in the quarter because of ratable revenue recognition. So billings is slightly better. You get a little bit more insight, but it's still pretty lousy. And so having gone through that at ServiceNow when I joined Samsara, we made it a pretty clear decision up front that we were going to disclose ARR. It's by far the best indicator of what's actually going on in the quarter. And I think that providing that transparency to investors is really important. So I think there's things that you report on in the quarter, and then there's what you ultimately guide to. So in terms of guidance, absolutely critical to put out metrics that you have a lot of confidence that you can hit, so that you can make sure that you're setting the right expectations and building trust with investors. So we guide revenue, op margin, and EPS. Something else that we do though is we provide modeling notes. We do a shareholder letter, which is basically a super detailed prose of everything that happened in the quarter, all of our metrics, intertwine all of our investor presentation slides. It's like, if you want the full picture of what happened in the quarter, this shareholder letter that we create is like where investors go. At the bottom of it, though, we have something that we call modeling notes, and it's basically some additional kind of qualitative information to help focus it analysts and investors in the right direction. So as they're kind of building their models, they have a little bit more kind of insight. So I think there's different strategies that you can use to get to the right answers or to manage their expectations versus kind of formal guidance.
The letter seems like a pretty big lift, but it sounds like it pays off with giving people the appropriate context.
We have a bunch of different mediums to communicate with investors, and we use them all for different purposes and strategically. So the shareholder letter is a thing that we spend the most time on. It's everything in there. We then have obviously the prepared remarks during the earnings call. That's basically a summary. It's like that. What are the key points that if you can't read this letter, what do investors need to know on the earnings call? We also have the investor presentation. And so if you can't listen or read, you can look at this deck and it has all of our metrics in it. You can get it really quickly. We use like Q&A to provide more context. So if we said something not very clearly, we'll get a question about it and we can provide more context in Q&A. We use like quarterly investor conferences, or we do like fireside chats to get broadcast our kind of our key quarterly topics and big themes that we want to make sure are resonating. And then the last one is we have an annual investor day. And that's, a venue that we use to talk about our long-term strategy. So we have a bunch of different ways to communicate with investors, and they each kind of serve a different purpose.
I love that. It's like there are different surface areas to get your message across, and each one can hit different, or you need all the information to be consistent and the metrics to all match, but you can add a little more color depending on the medium.
Yeah, absolutely. Different depth, different types of information.
Investor days. Do you think that it's good to do one every year? Some companies don't do them at all. Some companies do them like every 3 years. What's your take on that?
Similar to ServiceNow, we combine our investor day into our customer conference. These industries are more abstract to investors than they are for maybe for other companies that they're following. Letting them meet our customers and kind of hear their pain points and how they're deploying technology. We have customers come into our investor day and do a fireside chat. It allows them to kind of touch and feel the new products that we've announced, and they get to hear from everyone on the management team, and they don't always get that exposure. And it gives us a chance to again reframe them on what is the long-term vision. They're not making investment decisions, not all of them, for this quarter. They're thinking for the next 5 to 10 years, and the investor day really allows us to kind of paint that picture and show them what that vision looks like.
That's awesome. I'm gonna do a whole post on investor days now. Thank you. Um, while at ServiceNow, you led FP&A. You now manage it as a function at Samsara. So you've lived through annual planning at all different stages, and also like private and public. What are your biggest takeaways about annual planning that impact you today?
First of all, it's important to understand and appreciate where your org is today from a maturity standpoint, but also have a really strong view of like where does this need to go and what are you building toward. When I joined Samsara, we didn't have an annual planning process. We didn't do BVA's budget versus actuals at the end of the quarter. There was very little communication with each of the kind of the business functions. But over several years, we've greatly matured that process. I'm really glad we had a couple of years before we went public when I joined to really build up that rigor before we got into being a public company. But I would say like maybe the three biggest takeaways: build towards accuracy. Obviously, forecast accuracy is critical for managing external expectations. Refine and reforecast regularly. The business is changing. It's important to be dynamic. As new information comes in, things need to change. And it's important to be nimble and be able to kind of reforecast really quickly. And then the last one is it's important to build really good relationships with the business functions. Heavily engage the business in the process and make sure that you're closing the feedback loop with them so that they understand what missed and why it missed, and you can get more information from them so that again you can go back to that first point where you're building toward accuracy.
The closing the feedback loop is so key because I've made the mistake in my career of going out and asking people for inputs and going back and putting in my model, but then like I never went back and told them how things went. And it's like that's not fair. You got to complete the loop so they can learn from it too.
That's right, and that's like the real partnership. Like if you're doing this really, really well, they should think about their FP&A as their business partner. Like they have their HR business partner sitting in their staff meeting, their finance business partner. If they're adding a lot of value and they're plugged into the business, they're sitting in the staff meeting. And so that's the type of relationships that we're looking for.
I like what you also said, Dominic, about not over clubbing it at first. So I've worked at companies where the person I was dealing with had never had a budget before. They'd never been responsible for a budget before. I've also worked at companies where we were forecasting everything down to allocating rent for like the CMO, something that he can't even impact. So it's kind of like you got to know your stage.
It's okay to again know where you are in the journey, but with the view of where you want it to go. And that's a big part of FP&A is educating your business partners. Some of them have come from smaller companies and maybe haven't really worked in this process. Some of them have, I've worked at a much larger company and I'm very familiar with this. So the education is important. And then as we talked about, closing that feedback loop, letting them know, here's what actually happened versus what we thought was going to happen. Let's learn from that and then figure out how to, forecast more accurately going forward.
Can you give us an overview of the annual planning, budgeting, and forecasting process today at Samsara? How does it work?
We obviously, like almost all company, we have an annual plan. It gets set once per year at the beginning of the year. But as I said, we reforecast that throughout the year. So after each quarter ends, so after Q1, we reforecast the rest of the year. After Q2 actuals, we reforecast the rest of the year. So we're reforecasting the annual plan every quarter. And then within each quarter, we do a reforecast of that quarter after each month. We're in Q3 right now. After month one, we reforecasted Q3 again. After month two actuals, we reforecasted the last month. So you're constantly trying to take the inputs from the actuals and get closer to the pin. We do this 3-2-1 accuracy. Basically, after the first month of actuals, you want to be within 3% of what actually happens at the end of the quarter. After month two, you should be getting closer because you've got 2 months of actuals. You should be within 2% of the actuals. And by the end, in that last forecast, you should try to be across all of the forecastable areas within 1% of what actually happens. So that's kind of our cadence. And then in terms of the process, it's pretty rigorous. I would say we first actually start with a 1,000-day strategy. And we use that to kind of like think not only about the near term plans, but our kind of a medium and long term plans. And we roll forward that strategy every year. We're thinking about allocating capital for this year, but not only for this year's results, but for future years as well. So in this 1,000-day strategy, what are our large sales initiatives? What countries do we want to be in? Do we want to add more product or vertical specific specialists? What is the 3-year R&D roadmap going to look like? And then from a financial perspective, what are kind of the growth, the scale, and the profitability targets that we want over the next 3 years? Then once we've kind of set that, we lop off the last 2 years and we really focus going deep on the next year. And so the first thing we do for the annual plan is we set our operating principles. For us, that is, we want to demonstrate some amount of year-over-year leverage. We want to get a little more efficient, and we want to be operating at Rule of 40 or better on an annual basis. And then within those two guardrails, we're trying to grow as fast as we can. First thing we do as a team is we set our top-line targets. There's a big triangulation between finance, sales, and R&D. We're looking at a bunch of internal data points. What does the product roadmap look like? How much pipe can we generate? How much sales capacity can we add? How is that capacity ramping over time? How productive are those reps expected to be? We do external benchmarking of other companies. What do the competitive dynamics look like? Are we seeing any changes in the economy? Things that could impact top line. So we debate and we set top line targets. Then we set all of our profitability targets, all of our margins, based again on our operating principles. And then the difference between the top line metrics and these margins is the amount of money that we're going to spend and allocate for that year. We do functional bottoms up planning across each of the different groups. What's required to achieve those top line targets that we had just talked about, and then we work with the business to kind of finalize all of that. We try to have a really solid draft done by the end of Q3, and then we really are using Q4 to kind of make tweaks based on new information that you're learning in the final quarter of the year.
Sometimes you just got to give the guy the ball and let him cook. That was awesome.
Sometimes you do. Absolutely.
Dominic, it sounded like you have a capital allocation framework that kind of sits within that. Does that sound right?
For the most part, we allocate high 30s% of our revenue gets allocated to sales. This is a sales and marketing kind of led organization, very similar to ServiceNow, top-down direct sales motion. Those dollars clearly have the most direct impact on bookings, and that's why it ultimately drives the largest investment. For those go-to-market dollars, we're looking at investing in, really large TAMs, really large market opportunities where we think we've got a strong ability to win. We invest high teens, kind of 20% on R&D. Here we use like an investment horizon framework. So we're really trying to make sure that about 70% of the R&D dollars for this year are spent on this year's product roadmap, but that we're saving about 30% of those dollars for medium and longer term product bets. So we're thinking out multiple kind of investment horizons. The remainder goes to G&A, which is an area that over time has really provided a lot more leverage as we've scaled. We use, I would say, a hybrid of zero-based budgeting and kind of run rate plus incremental. I think some of our functions and organizations are mature enough where they're doing full zero-based budgeting every year, bottoms up. And in other cases, we're pushing functions to reduce their run rate with savings to fund some of their new initiatives before we will deploy, incremental dollars into those functions.
Dominic, your responsibilities at ServiceNow progressed across FP&A, corp dev, IR, and treasury. Can you give us the sequencing of those roles and what finance pros can consider when they map out their own path to a CFO seat?
Absolutely. And I think even going back before, becoming like an operator, like doing the investment banking was like an incredible background. It gave me such a good foundation of, corporate finance, understanding financials, governance, strategy, all of those really important topics that really helped me hit the ground running when I joined ServiceNow. So a very natural transition for bankers is IR and corp dev. You understand how to raise capital, you understand storytelling, you understand how to execute M&A transactions. And so over time, I was able to add FP&A, I was able to add treasury. I knew that I wanted to be a CFO, and before I picked up treasury and FP&A, I actually went out and I was trying to interview and land a CFO job. And I got pretty close on one. And the feedback I got was love the banking, love the IR and corp dev, very strategic. Not a lot of operational experiences. Like CFOs managing, at scale could be managing hundreds of people, hundreds of processes and systems and cross-functional, and you got to manage a big group of people. It's like it's very operational, and you've really not done any of that. And I use that to go back to Mike and say, hey, man, I want to be a CFO. And to do that, the feedback I'm getting is I need to be more operational. I need a chance to run FP&A, whether that's here or somewhere else. Lisa, who I talked about earlier, switched us. So I kept Corp Dev and FP&A, which she was running, and she took over IR and Treasury. And that was fantastic for both of our careers. We're both now CFOs. And so I think those kind of pillars are really critical. The other thing that I encourage people to do is you got to be proactive if you want to be a CFO. Make networking, part of your job. I had this huge spreadsheet. I had like all of the recruiters that interviewed for CFO jobs. I knew the different VCs and the kind of the talent partners at the VCs who were the board members. And I would try to interact with them as they could help influence CFO decisions. Be proactive. Do not wait for like awesome CFO roles just to find you and fall in your lap.
And I think there's a lesson in there that getting a job is a job in and of itself. It's not just going to show up one day and you're like, yes, I accept. You have to work towards that. And it may not just be getting the skills. It's like you said, having a spreadsheet of who to reach out to.
Especially your first CFO job. You by definition, whoever gives you that is taking a massive risk. You've never done this job. I will pick my head up if someone reaches out to me and it looks interesting. But the chances that you're going to find Samsara, for me, that was not going to happen if I just kind of was passive. And so it required me to be really proactive. It's probably a 12-month process.
And I always say that to become a CFO, somebody needs to allow you to become a CFO. And it's kind of like you're taking a chance in the company and they're taking a big chance on you.
Absolutely. Yeah. The risk goes both ways. It's a very big, in-depth process.
If you were to give CFO passport stamps advice, just key experiences one should seek out to build a high growth tech CFO resume, can you think of 3 or 4 that matter the most?
One of them would be, they're kind of 5 key pillars of being a CFO: FP&A, accounting, IR, treasury, and tax. There's clearly other things that go beyond that, but those are kind of 5 meaty pillars. Try to get as much experience across those as you possibly can. So I had a chance to run FP&A, started my career in accounting as a CPA, had run IR for 20 quarters as a public company and managed treasury. Did not do tax before becoming a CFO. So try to get, a broad set of experiences and try to get, again, operational experience if you can. And then the second thing I would say, and it's kind of obvious, is work for the best company that you possibly can. There's no way I would have landed at ServiceNow had I not worked at Morgan Stanley. Had Morgan Stanley not been the lead left underwriter on the ServiceNow IPO, I would not have met Mike and Frank, and I would not have landed that job. And had I not worked at ServiceNow, which has turned out to be this incredible company, I probably would not have had the opportunity to get the Samsara job. So get the right experience, but also marry it with getting in kind of the best company experience you possibly can.
So well said. There's an element of preferential attachment there where making one good choice leads to a bunch of other good choices.
I think the reason I got into Morgan Stanley is because landed a good business school program. These things all stack together. And so if you have a good view of where you're going or where you want to be ultimately, it really then allows you to kind of back into, the different experiences and roles and opportunities that you need to kind of look for versus randomly jumping into something and not really knowing, is that putting you on the right path or the wrong path, or what is that ultimately moving you toward your career?
Dominic, I'm going to take you into what we call our long ass lightning round. So I ask every successful person that comes on the podcast, you got to give us something that you screwed up on the job before. It could be this role or any other role.
So Mark Andreessen's on our board. And when I got the Samsara offer, he called me up and said, hey, congratulations. Meet me for a glass of champagne. And so I was like, that's awesome. Thank you. And I went and I met him in person. I carry this moleskin notebook with me everywhere. It's what I use to kind of take all my notes. And as I was going through the Samsara interview process, I had printed out the financial model. So I show up to this meeting, I bring in my notebook, and he gives me an hour of his time and he's answering all my questions. It was just fantastic. And at some point I had opened it up and I was showing him something in the model and, got in my car and I'm driving home. And I look on my passenger seat and I see the Moleskine notebook, but the model is not in my notebook. And I panic because it's like a forward-looking model, and I just got the CFO job. I immediately call the restaurant and I'm like, I left something. Please go look at this exact table. They walked over there. They're like, Mark's not there, and this document is not there either. I immediately call them and I say, hey, I left something at the restaurant. I didn't say what it was. I have it. I'll mail it to you. I said, I'd really like it back now. And he gave me his address. So I drive over to get it, and he comes out and he hands it to me like in a manila like envelope, basically, and like hands it to me. He doesn't say anything, and I said thank you, and I drove away. And like we never talked about it, but like, man, what a biff that would have been had like somehow someone else gotten a hold of this model as I'm the first CFO of the company.
To put my tinfoil hat on, do you think this was all a test and he would just, slyly grab these like, well, the CFO called me for it and you passed the test?
I don't know, but he was very polite about it. Not like even a smirk on his face. Like I think there's a very good chance he knew what it was, and he never mentioned it to me. So
Yeah. What an amazing story. I'd be sweating in the car on the way home.
very nervous.
Knowing what you know today, what advice would you give to your younger self?
Don't be afraid to take risk. I think leaving Morgan Stanley, I was very nervous. IT help desk company down in San Diego. Like how big is this going to be? Leaving ServiceNow, which is again continued to be this incredible company, to go to Samsara, this kind of early stage startup. Those are both like incredibly good decisions. In hindsight, I'm so glad I made those decisions. But in the moment, having the confidence to take the risks, believing in yourself, that things are ultimately going to work out, I think would be good advice for myself.
More of a technical one. What tools does your team use today to get the job done? Can you walk us through your software tech stack?
Yeah, so we use NetSuite for ERP, Stripe for credit card transactions. We use Zip for procurement. We do our planning and adaptive on the kind of the teeny side. We use Expensify and Navan. We use Databricks as kind of our data lake. Some folks are using both OpenAI and Claude, and then even beyond finance, things like Workday for HCM and people related tasks, and obviously Salesforce for CRM.
Last one I got for you. What's the craziest thing you've ever had someone try to expense?
I'll be honest. I've not had anything crazy come across my desk, and I think it's like I'm pretty into the details. I think people know, like I look at like who are the top spenders, and people know that I'm looking at this data. I still get a lot of the exceptions come to me for approval. So I don't know if it's because I get into the detail in a way where like people aren't trying to like any funny business. I think the other interesting nuance that we have about our business is we don't have a lot of corporate cards. There are kind of like a few departmental corporate cards, but we try to push all of our expenses, people-related expenses, through Navan for all of our travel, and then through procurement if you're gonna, procure software. And so employees for like meals will use their own credit card, which gives them the benefit of getting all these like points and rewards, but at the same time, maybe it makes them a little bit more careful about like what they're thinking about expensing and pushing through, because it's not on a corporate card. So that's probably driving that as well.
Dominic, thank you so much for being generous with your time. I appreciate it.
Thanks for having me.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.